Dividend investing, it's the most prioritized investment strategy for the second half of 2023, according to public platform survey. More than 50% of the 1,000 users that they surveyed indicated dividend investing as one of the strategies that they are interested in as part of their overall portfolio strategy. The popularity of dividend investing trumped AI, big tech, and even the total market indexing. Personally, I've never understood why a company paying dividends or not would actually affect your decision to buy into the company's stock. But since this strategy has essentially stood the test of time and so many people have seemed to swear by it, I've decided to go down the rabbit hole in search of the answer on whether dividend investing is the best investment strategy. So the appeal of dividend investing is relatively simple. Many investors are probably enticed by the idea of passive income. So there are two parts behind this concept: passive and income. So passive, it's simple. It just means that one can sit on their lazy ass, I mean to enjoy the fruits of their early labors as their money works harder for them. Income, on the other hand, illustrates the predictable and steady flow of money coming to you, just like salary. Now, let's get to the basics of investing 101. So the first principle is of course to smash that cute little like button. I got you there, didn't I? But really, when you're buying into a stock, you're not buying into numbers and digits on your screen, on your smartphone, or even on your laptop. But instead, there is a real vested interest in the company behind the ticker symbol. So when a company makes a profit, you get a share of the profit. But since we are all minority shareholders, we don't really have a say in the company's financing and even investing decisions. Usually, there are four things a company can do with their earnings to create shareholders' value. So they reinvest in themselves, they give out dividends, they do share buybacks, or they just retain it on their balance sheet. Of course, there are different circumstances as to why a company will pursue a particular decision, and it mostly depends on the available opportunities of the company. So younger companies tend to reinvest back into themselves or retain it on their balance sheet to build up cash buffer, while more matured companies tend to give out dividends or even do more share buybacks. Of course, contingent on the fact that the share is probably undervalued. Which brings me to the first point arguing for dividend investing. So you very much prefer matured companies with a track record that you can hold them accountable to. So there is even a term in the finance world called dividend aristocrats. And a company will be considered a dividend aristocrat if it raises its dividends consistently for at least the past 25 years. So like every disclaimer, past performance does not guarantee future results. But if you think about it, if a company is able to prove that they can grow the dividend payout for the past 25 freaking years, it probably signals to investors that they might have a particular advantage of delivering profits sustainably. The keyword here is they might. So companies like IBM and Colgate are awarded the dividend aristocrat title. But if you really look at their entire total return profile, their stock pretty much stayed flat, or maybe went up around 10% for the last 5 years. And investors only enjoyed the 3 to 5% dividend payout per annum, after tax of course. So is it really a good deal? I'll let you be the judge. The second point arguing for dividend investing is that you have better autonomy and control over your capital. So when excess profits of the company are returned back to us shareholders or investors, we will have full control over how we wish to deploy them. However, if the company chooses to retain it on their balance sheet or even reinvest in themselves, it might not necessarily lead to a better stock performance because companies do actually do stupid things all the time. That said, let's not forget that we too are humans and investors do stupid things all the time too. Therefore, the company must be governed in a way where the management and shareholders' interests are deeply aligned. Now, the third point arguing for dividend investing is that it takes emotions out of the equation when you need the income. So I see a common argument between investors that you can also achieve this air quotes passive income by routinely selling a fixed percentage of your portfolio so as to model after this dividend payout. So the issue is mainly execution. So as we know, markets tend to be very emotional and volatile in the short term. So in the event that you need to execute a sell order to generate that so-called passive income, there will inevitably be a few questions. Which stock should you sell? In what order? And how much? So many of these questions will overcomplicate the process because we all have our inherent biases and might think that, hey, maybe a certain XYZ stock is overpriced, so we sell more of it while waiting for the laggards stock ABC to catch up. However, it's often the case that we might be watering the weeds and cutting the flowers. Moreover, there are trade-offs and pitfalls investors should consider before diving in dividend investing headfirst. First, I repeat, do not go blindly chasing companies that have a high dividend yield. If you believe that market is largely efficient, it means that there is definitely a catch behind the companies having such a high dividend payout, and you better get to the bottom of it and determine whether it's a temporary or structural problem. Second, as high dividend instruments like REITs have incentive to pay out roughly 90% of their profits to investors, this also means that such companies have very little liquid assets on their hand. When a company wishes to expand, they will usually undergo some sort of rights issue to raise capital, and investors must get ready to subscribe to the extra shares unless they don't mind getting diluted, which would affect the subsequent dividends they receive per unit. So here is my beef with dividend investing. To me, I don't see the logic of having a preference for dividends. A stock paying good dividends, depending on how you define a good yield, does not tell me whether the stock is good or not. In fact, when a company chooses to pay out a hefty sum of their profits as dividends, it means that they are offloading their assets, giving it back to shareholders, causing themselves to be a much weaker company overall as they distribute their coffers. The even more worrisome trend that I've observed is when investors think that these quarterly or even yearly dividend payouts are like some sort of bonus money being handed out by the companies that they own. Further, some investors might also be under the impression that the dividends that they received are guaranteed and also sustainable, which couldn't be further from the truth. Companies in a distress or a turnaround situation will usually cut their dividends. Intel. And those caught in a very bad macro environment might even stop their dividend payout until further notice, like Boeing during the COVID pandemic. Therefore, I find it hard to reconcile the unpredictability of dividend payout with this idea of the passive income promise. So here's the bottom line. The holy grail of investing revolves around one word that starts with the letter E. Want to take a guess? Leave it in the comment section down below. I'll wait. Now, it's earnings. Only one thing matters when investing into companies: how they grow their earnings. So it really doesn't matter what investing strategy you employ, whether is it one of dividend, one of growth, one of value, or one of deep value. We always want to look out for companies that have the unique advantage to grow and sustain their bottom line earnings. So the stock of DBS Group, Apple, Microsoft, they're good not because they pay a good dividend or buy back shares aggressively. They're good because they are inherently a strong business with a huge economic moat that enables them to earn supernormal profits over long periods of time that benefit shareholders in the long run. So focus on the company, not the dividends. So this is CK from Piranha Profit signing off. Till next time, keep winning.